Greetings, everybody. Welcome to Liberty Call. Today is Wednesday, February 14th, 2024. Hope everybody's having a fantastical day out there. It's Valentine's. Not an important day to me because my birthday is tomorrow. Valentine's is a Hallmark holiday. It doesn't matter. So don't tell my wife. Anyways. All right. Hope, like I said, hope everybody's having a good day out there. It is a beautiful day here in Colorado. More sun, a few more clouds than yesterday, but it is still lovely weather. Not too cold, not too hot. So, all right. Looks like the markets were in a little bit better mood. They bounced back from yesterday's debacle after the CPI report from last week. Everyone kind of panicked over. So, all righty. Well, if it is your first time watching the show, if you could give me some thumbs up, like, share, subscribe, follows, and press that notification bell. Let's go ahead and get into today's numbers and see how things turned out. Dow Jones was up 0.39%, 150 points, closed at 38,423. S&P 500 up 0.93%, closed at 49.99. NASDAQ up 1.3%, closed at 15,859. The VIX fell 8.83% today. It's back down to 1445. Canada up 1.48%, Brazil down 0.91%, and Mexico up 2/3%. In Europe, Germany was up 0.38%, the UK up 0.75%, France up 0.68%, Netherlands up 0.12%, Spain down 0.09%, Italy up 0.63%, Switzerland up 0.64%, and Portugal down 0.55%. Russian exchanges both red today. The MOEX down 0.06%, the RTSI down 0.24%. And the Asian markets, most of them were still closed, but we'll start out with the Nikkei in Japan was down 0.6%, Australia down 0.74%, New Zealand down 0.82%, and the Hang Seng was open and it was up 0.84%. All the rest of the Chinese markets were closed today. All righty. All right. Well, let's go ahead and move on over to the market recap for today. Stocks rebound on dip buying action following inflation-led sell-off. All right. On Wednesday, U.S. stocks bounced back as investors seized the opportunity to buy the dip after a previous day sell-off triggered by a stronger than expected U.S. inflation report. Uber Technology surged 12% to hit a new 52-week high following the announcement of a $7 billion stock buyback program and optimistic gross bookings growth projections anticipating mid to high teens growth over the next 3 years. Lyft Inc. soared 33% after surpassing expectations, with its guidance and quarterly results driven by increased gross bookings and cost-saving measures. However, Lyft's gains were initially higher in after-hours trading on Tuesday, but moderated after a forecasting error regarding adjusted EBITDA margin expectations for 2024. Yeah, I think someone moved the decimal point too far to the right, and it was like 500 instead of 50. So it messed up one of the reports. Jumping back in here, Federal Reserve Bank of Chicago President Austin Goolsbee, who is a certified retard, reassured investors that despite upside surprises in inflation, the Fed remains committed to its inflation-fighting goals, indicating that rate cuts could proceed even if inflation slightly exceeds expectations. Again, Mr. Goolsbee is a political hack. He was in the Obama administration. He's dumber than a box of rocks. He's just going to repeat whatever his overlords tell him to say. So don't believe whatever comes out of his mouth is just whatever his bosses say. So he's not someone you can really trust to evaluate data. This statement followed Tuesday's inflation data, which revealed a slower than expected decline, dampening hopes for an imminent rate cut. Meanwhile, Airbnb faced a slight decline, citing an anticipated slowing of bookings rates in the current quarter due to tougher year-on-year comparisons. Kraft Heinz Co. Witnessed a more significant drop, with fourth quarter net sales missing projections attributed to decreased demand following recent price hikes. Conversely, Robinhood Markets experienced a notable increase, surging over 12% after reporting strong guidance and quarterly results, particularly driven by heightened crypto and options trading. JP Morgan Securities upgraded its price target on Robinhood, emphasizing its robust momentum and disciplined expense management, noting the company's substantial funding and relatively low enterprise value, making the stock an attractive investment opportunity. All right, so that's the news of the day. Let's dive into some not so good news. This comes from Zero Hedge. It's titled "Economists Are Sounding Alarm on YOLO Credit Bubble." And this comes from Sam Borgi of creditnews.com. Let's see what Sam had to say. In a cautionary tale, economist David Rosenberg of Rosenberg Research warns of a burgeoning credit bubble fueled by a growing number of Americans indulging in what he terms as YOLO spending, epitomized by the mantra, you only live once. This recklessness in spending, he argues, has led to a significant increase in consumer debt, which now constitutes a dominant 70% share of the economy, creating the illusion of a robust economic outlook. However, Rosenberg points out the underlying risks associated with his credit bubble, or with this credit bubble, highlighting a concerning trend of rising delinquencies in credit card payments. Currently, 1 in every 12 credit card holders is struggling with payments, reminiscent of levels observed during the 2011 recession when unemployment was at 9%. Despite the current low national unemployment rate of 3.7%, Rosenberg asserts that the default cycle in consumer credit has already begun. Recent data shows that Americans accumulated an additional $50 billion in credit card debt last quarter, reaching an all-time high of $1.13 trillion. While this debt accumulation may not immediately raise concerns, economists emphasize that the potential dire consequences if employment conditions deteriorate. Signs of stress are evident, especially among middle and lower income groups, exacerbated by factors like inflation and stagnant wages. The holiday season, often characterized by increased consumer spending, further exacerbated financial strains for many Americans, with millions resorting to debt to finance festivities. As the festivities fade, the reality of debt obligations sets in, particularly for those already living paycheck to paycheck. While economic growth projections remain positive, economists caution that any slowdown coupled with rising unemployment could trigger a self-reinforcing credit crunch, turning a mild downturn into a more severe economic crisis. And yes, anytime delinquencies start to go up, that is definitely a sign of trouble in the economy. I spent a decade in the credit and recovery side of the banking world after I got out of the military, and it's a fun job, tracking deadbeats down and getting squeezing blood out of a stone. So, I mean, hell, if the economy goes to crap and there's all this defaulted debt, maybe DSA Financial Group will diversify into the credit recovery business. Buy that debt at pennies on the dollar and get paid back. It's not a bad deal. Anyways, all right. I prefer the investment world. All right. One last article here comes from the Mises Institute, their Mises Wire. This article is titled New Jobs Report, Full-Time Jobs Disappear as Fewer Americans Find Work. All these jobs reports come out and say, hey, see, it's all wonderful. But I mean, if one person gets fired from a full-time job and then goes and gets 2 or 3 part-time jobs, I mean, it's not 3 jobs. It's one person working, 3 part-time jobs. All righty. The latest report from the Bureau of Labor Statistics revealed that the economy added a remarkable 353,000 jobs in January, maintaining the unemployment rate at 3.7%. Dubbed as a shockingly good jobs report, and that's in quotes by CNN, this monthly ritual of highlighting strong employment figures has become a routine media discourse, often portraying a rosy picture of the economy solely based on this single statistic. However, this approach overlooks critical economic indicators that paint a more nuanced picture. Despite the booming jobs market, several indicators, including the Philadelphia Fed's Manufacturing Index and the Leading Indicators Index, point towards recessionary trends. Additionally, business bankruptcies surged by 58% last year in 2023, signaling underlying weaknesses. Delving deeper into the jobs report, discrepancies emerged between the establishment survey and the household survey. While the former showed substantial job gains, the latter indicated job losses for the second consecutive month, with January witnessing a decline of 31,000 employed persons. Moreover, the growth in part-time jobs overshadowed the decline in full-time employment, raising questions about the quality of jobs being created. Government jobs, constituting over 20% of new job growth, because we need more parasites sucking off the teat of everyone else, are reminiscent of pre-recession levels, while the persistent decline in temporary jobs suggests economic fragility. Real wage growth, touted as a positive, is overshadowed by the long-term erosion of purchasing power, with earnings struggling to keep pace with soaring housing costs. Despite these warning signs, mainstream media perpetuates the narrative of a robust economy solely on job growth, while the Federal Reserve's policy decisions hinge heavily on these figures. However, a deeper understanding of the economic fundamentals is essential to discern the true trajectory of the economy amidst growing uncertainties and vulnerabilities. Yeah, you can't just look at the jobs numbers because I've said this probably 1,000 times. Those are lagging indicators. Companies aren't going to fire their people until they absolutely have to. And that's going to be the last thing on their, I mean, they'll cut everything else they can, and they might get rid of the garbage employees, but the ones you really want to hold on to, those are going to be the last ones they're going to get rid of. So, and typically, going back to my experience in the collections and recovery, typically the folks who are habitually late on their bills, those are usually the first people to wind up getting laid off when business gets tight. It's a mystery that people who don't pay their bills on time are also the same people who don't show up to work on time and are usually the first ones fired when it's time to trim the fat. So, go figure, folks. So if you're out there, show up to work on time so you're not the first person fired. All righty. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. It's right here on the screen, dsafinancialgroup.com. And if you need anything from me, like I said, please go to the website. All my information's there. And hope you have a wonderful Valentine's evening, and I shall talk to you next time. Adios.